The World Bank halves global economic growth. What else do the major authorities predict for 2023? Hi, everyone, and welcome back to another episode of Insights brought to you by Ainslie Bullion and the Gold and Silver Standard. Today, we're joined by Josh from the Ainslie team back from holidays. It's good to see you again, all ready to share your analysis for another year.
Let's go, Chris. I'm keen to get into it, mate.
Excellent. So today's news was all about predictions for the year ahead, this is obviously the time everyone makes them. And they were really about the economy generally. But of course, there's implications for the price of gold and silver whenever you start looking at where we think we'll be in a year from now. So what were your main takeaways from what were really quite a wide range of predictions that were reported in the news today?
Well, yeah, last year was a pretty wild one, and I'm excited to keep discussing with everyone what's going on in the financial and bullion world for the next year. So I suppose let's jump into it. I wanted to do a bit of a deeper dive into some of the 11 predictions that we put in today's news. There's a lot of really scary quotes in there, so I wanted to sort of look a bit further into the background to see what's actually behind them. So for number one, the IMF saying that they expect 1/3 of the world's economy to be in recession. Broadly, that's due to the big three economies, the US, EU, and China, all slowing down at the same time. As we've covered a lot last year in Insights, recession predictions reflect the pressures in the economic world, such as we had the war in Ukraine, supply issues, inflation pressures, the rapidly expanding interest rates. We all know the story by this point. But looking forward to the next few months, the IMF say they actually believe that China is going to be experiencing the brunt of all those pressures. Of course, in the modern globalized world, this actually means that everyone's going to feel China's pain. But as for the states, they think the states are probably going to be the best ones given the environment. They also say that they could avoid a recession if the labor markets remain strong. So that's going to be a very important piece of data to follow going forward. But of course, we have no idea what the next 3 months actually look like.
So talking about China, because we mentioned this a little bit yesterday in discussing it with Branko, and there are actually some questions around that when from people who watched the video sort of going, well, hang on, because you're sort of saying that China reopening could be bad for precious metals. So if we look at it from that angle, as you open up and then people aren't, the central bank isn't being that big buyer. But then there was actually a comment someone made in the comments about, well, doesn't this mean that you've got more mum and dad investors who are going out into the market now and buying up precious metal because they're worried about what's going on more broadly in the economy? So I could see that argument as well. Do you have an opinion on sort of where China fits with this precious metal story?
The precious metals story is a bit more difficult because, as it always is with precious metals, it's usually that lagging indicator. So we usually see the trend coming in here a couple months after. So we're always sort of behind, but it always works out in the long run. But to go further on with China, it's actually a good segue to point 3 in the news, which was about the World Bank saying that a string of financial crises in emerging markets and developing economies could have lasting harm at the moment, which actually plays into what we're discussing about with right. China copping the brunt of all the economic troubles. So all these emerging markets and developing economies, China's so critical for them. So all of those do not have diversified production basis, and they're bound to China, really bound. They all rely on small numbers of goods. Most of the time they rely on tourism. And what's happened in the last 3 years was pretty much the worst case scenario for those economies. And the future looks uncertain for them as well, with the potential for increasing poverty rates in probably most regions. And you can imagine even over there as well, they're thinking about gold as well in terms of how do they protect themselves even as a small economy.
So what you're sort of, if I'm summarizing correctly, what you're saying is that China itself isn't necessarily the problem. It's the correlation that China has with all of these other developing markets because they're also reliant on China. Is that where that differentiation lies?
I think it's everyone relies on China. So everyone's going to feel the impact of it, but particularly the emerging markets.
Yeah, okay. So that was really sort of there were several predictions there that sort of centered around that sort of China situation, but were there others that you wanted to look at that really looked a little bit more about the US or what was happening in other places in the world?
What I liked with the US, mate, was I want to bring it back to point 7, which was probably the next one I wanted to
Yep.
talk about, with Larry Summers saying that
Yep.
he thinks it's much harder than most people think to achieve a soft landing, which I've been reading a lot coming out at the moment saying that they think it'll be a short and soft landing. Larry Summers doesn't think so. So I wanted to sort of look into that again and see what had to go right for us to achieve that outcome. So first of all, we need inflation to stop, come down quickly alongside central bank interest rates, which will need to drop too. And we've got the Fed rates expected to sort of stop at 4.75 to 5% early this year in the next couple of months. So what we actually need is optimism to come back, which for optimism, as we know, it means that we need certainty and a clear path forward, which we haven't had, especially for the last year. So that optimism, if it does come, will boost equity markets, and the downturn needs to be saved by people's personal savings, which they accumulated throughout COVID, and the housing market needs to recover too. That's a pretty tough, but best case scenario. So I can see where Larry's coming from, saying that it's actually not that easy. There's a huge risk of sticky rates this year. So everything just stays high. Inflation stays high, but not increasing. So our rates will have to stay there too. And if that happens, the labor market remains strong. So maybe he's right. Maybe it's not a soft landing, but we just have that really crap environment for a bit longer.
That's a very tricky one. I've been reading a lot of analysis as well, and it's difficult because what we've seen the last few days, where we've really had the markets pick up on expectation that CPI is coming down. So the inflation, this argument about sticky inflation may be the case, but then there's other predictions from people who really are looking at where this goes, like the forward data, I suppose, saying that it really drops off a cliff. So we may get negative, and I think that was sort of implied through some of his work, Larry's work as well, that we may actually see a real drop off in inflation very rapidly. But then the risk is that something happens more like the 70s or the 80s, where you had this bounce again, so that the inflation disappears quickly, which is a good thing, but then comes back just as quickly with another round. So it's almost like COVID waves. You think you've got through one and then you get the next one. So is that something?
That actually was one of the last points we had in the news, number 11, which was Michael Burry saying that he says inflation's peaked right now, but we've not seen the last peak of the cycle. So he says that we're likely to see CPI lower, possibly even negative in the second half of this year, and the US in a recession. But then he predicts the Fed will cut rates, government stimulates, and then we've just redone the cycle all again. So that's another plausible prediction for the year to come. You got him saying, we got the waves of it, others saying it'll be sticky. But no matter which one's correct, I think it wraps up what the theme of 2023 is going to be, which is there's kind of no easy or certain path forward. It's going to be rocky no matter what happens this year.
And we always have to have in the back of our mind as well, I think, that these predictions that are going into probably a lot of what you've talked about there is probably over the next few months to half a year, not necessarily the end of the year. But we always have to remember that the market is forward-looking as well. So if we can have very negative predictions going on and saying that the growth is going to drop, fall off a cliff, the inflation is going to pull back, unemployment's going to rise, but the market can look ahead of that and see exactly that last point you made about the Fed government's some sort of pivot coming where liquidity starts flowing again. And when that happens, you would expect all these assets to rise. So I think we've always got to be careful about being too positioned for the doom cycle, because we can absolutely go through all of those negative predictions and still have a relatively strong year for the market when we look back in 12 months' time.
Yeah, always play the market. Of course, there's other factors as well, but you're absolutely right, Chris.
Okay. Well, Josh, it's been great to have you back on. So thank you so much.
Awesome. It was great.
We really appreciate that. And thanks to everyone for watching. As always, if you have any comments or questions, we'd love to hear from you. So reach out on the socials, because we have people watching that all the time, and we'll get back to you, or we'll comment in here on the insights program and the next one when we get that opportunity. So we'll be back again tomorrow with Alex. So that'll be her take on the unfolding start to 2023. Looking forward to that. And I'll see you all tomorrow to continue our exploration of this new year of news.